What's going on out there? It's December 1st. My friend Curzio, it's the Wall Street Unplugged podcast where I break down the headlines and tell you what's really moving these markets. So I want to jump right in here with a great guest who's John Petrides, portfolio manager at Tocqueville Asset Management, huge favorite of yours. I know that based on downloads, and I can see why, since he always shares new ideas with you and also able to weigh in on everything that's going on, right? We got the markets, economy, the Fed, including Powell's comments from yesterday afternoon, which pushed the markets higher. Let's bring him in. John, what's going on, man? How's everything?
Hey, Frank. Thanks for having me back on. Appreciate it. Good seeing you.
So good seeing you too. So explain the markets to me, because I always look at it from like the individual investor, right? Who listen to people like me, listen to you, you know, who just going about their business and say, hey, you know, I want to listen to podcasts, I want to listen to certain people they like. And I think in this week, I realized that China growth is absolutely done. And the next day, it's perfectly fine. And then I realized that the Fed is going to slow interest rates, which I guess you could interpret that however you want. It could mean 25, 50 basis point hikes, which is slower than 75. And then after Powell speaks, kind of says the same thing, and the market roars higher, right? Especially growth stocks. And this is like, you know, just daily things that are going on with the market. It's almost like you're trying to balance. How do you handle this kind of volatility with your clients where it seems like everything's bad, everything's good, everything's bad, where it's almost hard to hold stocks with the volatility we're seeing in some of these names?
It's been a tough year, you know, especially if you're a trader. You know, we are investors. We definitely take a long-term time horizon to when we're, you know, buying a new position or selling out of a position. But you know, the volatility this year, I don't know the numbers, but I would presume that the percentage of trading days this year where the market, the S&P 500 has moved north or up or down 1% on a per day basis has to be some of the highest we've seen, definitely since 2008. I mean, the whole year has been massive moves of 1% greater or less. And it's kind of like if the market doesn't move a percentage point or greater, you're kind of like, well, it's a quiet day. Meanwhile, last year, there was no volatility at all. So, you know, if you're a trader in this market, good luck, because, you know, the whipsaws are really profound.
So I like talking to analysts like you, lots of experience, because for me, it's never about, you know, pounding the table on my thesis. I want to talk to people who have, you know, a different opinion. And I don't know if you do or not, but I'm struggling to find out, because the bullish case for stocks I see over the next, say, 12 months to 24 months, even 12 to 18 months, is that we need to see unemployment skyrocket. We need to see earnings come down sharply, which are going to come down sharply, right? Because inflation margins are getting tight. Sales are good, but let's see how good those sales were in terms of the margins that they generate through the holiday sales. You know, we're hoping for demand to slow incredibly. Again, something else that's going to hurt earnings. This is the bull case I'm talking to you about. But at the end of the day, the Fed is not like we should stop throwing around the word pivot. Pivot means that they're going to reverse and start lowering rates, which is not going to happen for a very, very long time. They could stop, but even when they stop, we're looking, even after Powell's meeting, right, yesterday, and stocks went higher, I couldn't find out what he said differently. And even afterwards, if you're looking at Fed funds futures, they still have a terminal rate, which is the peak rate at 5%. When they get there at 5%, they're not lowering anytime soon. How could we expect earnings to hit record highs next year when interest rates were basically zero, if you're looking at the past 3 years, but now they're going to be so much higher, which we're seeing demand fall off a cliff in housing, interest rate sectors, and who knows what the recent 75 basis point hikes and further hikes that are coming are going to do over the next 6 to 9 months in the market. I'm finding it hard to find a bullish case for the market in general, not every stock, but for the market in general. It seems like you got to be careful here, but, you know, poke holes in my thesis if you can.
Frank, I think you are the way you articulated your question captures the current environment, because your question was so long, you were running out of wind to say your question. And that's the point of what's going on, is that let's unpack it in 3 ways, right? Let's unpack the Fed, let's unpack the economy, and let's unpack the markets, because people are confused, and everyone should be confused, because, you know, when you have an unemployment rate of 3.7% and people are talking about recession, something doesn't make sense, right? So let's unpack it. Let's unpack the Fed first. I was at a conference 2 weeks ago where former Fed Chair Bernanke spoke, and I thought he articulated the Fed policy very well. He said there are 4 stages to what the Fed is going to do. They're rising fast. They're going to slow down the pace of their interest rate hike. They're going to pause, and then they will adjust. So we are at the end of the Fed raising rates at a fast pace, right? We came into the year with the Federal Reserve at 0% interest rates, right? Mm-hmm. This time last year, Frank, the Fed was still buying assets. Think about that. Yeah. So we came in at 0% interest rate. The Fed didn't start raising rates. They didn't start tightening until March, right? So we are essentially 9 months. In 9 months, the Fed has gone from buying from 0% interest rates to now we'll be over 4% by Christmas time. They've gone from buying assets to now they're rolling off assets at $60 billion a month, right? So massive tightening. They've pulled massive liquidity out of the economy. So that massive rapid pace is now slowing. So instead of 75 basis points, they'll probably do half of 1% in December. I would assume half of 1% in January or February, and then maybe a 25 basis point to get us to 5%, 5.25%, something like that by March. All right. What the Fed, in my opinion, and then let's go back to Bernanke's comments. We increase fast, we slow down the pace of increases, and then they're going to pause. They're going to let that marinate, Frank, like your Thanksgiving turkey. It's going to sit in a brine until the summer. You know why? Because the Fed in my opinion, the Fed wants a 30-year mortgage to have a 7% handle on it going into the housing market season, the spring season. The Fed does not want a head fake here and a 30-year mortgage comes down below 7% and people say, oh, I got to buy now because interest rates are lower. They want that to sit higher. They want to make sure the housing market continues to go down because when housing slows, there's so much of a ripple effect that slows the rest of the economy down, okay? Mm-hmm. So they're going to let interest rates, in my opinion, marinate until the summertime. By then, hopefully, inflation should be with a 4 handle by then. Below 5% in the summertime. Then the Fed will start talking about adjusting, right? So we've risen fast. We're slowing the pace of rising. We're going to pause, and then the Fed will adjust. So then they start talking about adjusting. Then they start talking about, maybe in the fall or come in 2024, inflation should get below X, and then we could start maybe reducing the pace with which we're rolling assets off the balance sheet. Maybe we cut interest rates. I would suspect that by this time next year, inflation hopefully has a 3 handle on it, 3%, 3.5%, something close to 4%, something like that. I'm hoping the Fed is now talking about reducing interest rates or has already started to reduce interest rates. If they were at 5%, 5.25% by March, maybe they're at 4.75 on the Fed funds rate this time next year. Because out of all that, inflation should be slowed because the economy should be in some sort of recession. The economy should be slow enough that we should be in recession. So that's the Fed. Now let's talk about the economy, right? The Fed is trying to kill housing. You want to slow the housing market. That has a ripple effect. You increase the cost to borrow money, so companies cannot reinvest, and they have to lay people off, right? So then you lay people off, and that, again, should reduce wage growth. That should reduce rental growth. Those two components are massive in terms of the inflation index, and then that should slow the economy. And then now let's talk about earnings. Margins are definitely off their peak. Margins in the S&P 500 peaked at around 17%. We're now at about 16.5%, going lower for sure. There will be ultimately earnings growth this year. Next year, earnings will probably come in lower. And what you should ultimately have in 2023, and why you're saying the bull case for stocks and why they could rise, is the Fed will be done and reversing course on interest rates, and earnings should have re-rated lower. And part of the difficulty that stocks faced this year was, companies by and large did okay. The problem was, Frank, 2021 was so strong. So their comps, their comparables, the year-over-year growth, the hurdle rate was so high. Think about it from if you're in the Olympics and you're pole vaulting, right? Every time you hurdle the bar goes higher. Well, we were at, 20 feet to pole vault over. And guess what? We hit the bar. So now the bar is lower. What's going to happen next year? Hopefully commodity prices stay range bound this year in 2023 compared to 2022. So you don't have that rate of change, massive gap. You're going to have companies lay people off and not hire. That's going to help margins. You're going to have less advertising spending and SG&A, as they call it, selling general administrative expenses. That should help margins. So all of those things companies will fight to offset a declining top line, right? Companies' top line, their sales should slow next year, right? So companies will try to protect their earnings by cutting costs and buying back stock, okay? That's going to be their last line of defense here. But what that sets up for, though, is 23 into 2024, you should be at, your margins have reset, the Fed has reset, stocks should have weakened at some point in time, and you could be off to the races. So what I'm thinking is that you have a continued volatility in the first half of 2023, and I think you would have a stronger stock market rally into next year, into the end, into 2023, and I think that potentially sets up actually another strong stock market rally into 2024. That's kind of what I'm thinking. What throws ointment into all of this is that the recession that we head into is more severe than what I'm thinking. Number one, geopolitical risk goes to the next level. Russia goes nuclear. China invades Taiwan. You have rumblings now with South Korea, North Korea, something like that. And then the other thing that you're seeing it on the crypto market with FTX and all that stuff. Frank, 2021 was a banner year in the private equity market. Private equity has the luxury, unlike the public markets, is that they can wait to mark the valuations on their investments in the following quarter or the following year. They could drag their feet. In the public markets, you can't, right? The public markets, the reason why the public markets are being so volatile is companies are going to be marked to market daily on where interest rates are, right? That's what's moving stuff. Private equity, you don't have that, right? So the day of reckoning is coming on the private equity market. On all of those 2021 investments are going to have to be marked lower. So, and a lot of leverage was pumped in the system. So if you have private equity companies that are out there that took on too much leverage and their assets now marked lower, what happens then within the credit markets, right? So I'm not saying, that's something where my antenna's up, where I'm watching to see if there's any risk where that could impact the credit markets. So I'm giving some ideas of what could throw some the flies in the ointment to what I think next year could ultimately be a significantly better year for the stock market than 2022 for sure.
No, that's well explained. I love it. Now, the thing I have a problem with is when I look at the markets, and that's a great thesis, is that it's all contingent on the Fed lowering rates late next year. Yet we don't have any of the estimates out there. We don't see inflation coming down below 4%, right? I mean, Goldman Sachs, I think, has it at 3.5% at the end of 2024. The Fed's making it clear we want to see it go back to 2%. Maybe they readjust and say, okay, 3% is good, 3.5%. But if they're at 4% or even 3%, to me, that's enough to stop. But at 3%, are they really going to reverse course? And when I look at a market where interest rates and higher interest rates take its toll, where what happened? We saw $11.5 trillion injected into this market over the past couple of years. You could debate whether you liked it or not, if it was BS or not, or if we needed that much or whatever. The fact is that they're reducing the balance sheet and they're taking a lot of that liquidity out. When we didn't have that liquidity, the S&P 500 earnings at the end of 2018 were 159, were 160. At the end of 2019, they were at 159. So they peaked. Right, we saw that 2019 the markets roared high because we decided to lower interest rates below 2%, but that was the peak earnings. We're removing this liquidity out of the market, right? And this even going past interest rates. It's not just interest rates going higher, and then they're going to peak, right? So say we peak at 5%, we go to 4.5%. Say you're right, even towards the end of the year, they're still reducing their balance sheet and taking a lot of that 11 trillion they're trying to take out of the system that they put into the system. I'm finding it difficult, even with cost cuts, of how we have record earnings next year, because that's where we're set. Because the earnings adjustment is, at the end of the day, I think we will both agree earnings drive stock prices. I'm finding it difficult to see how 235 is the estimate, which would be record earnings. They're still set to grow next year, every year, based on analyst estimates, when 160 was a peak in 2019 when none of COVID happened, when we peaked. And now we're seeing all this liquidity move. It's... Maybe for me, I'm worried the adjustment's going to be a lot bigger than what people think. And I hope it's not, because if it is, we're going to see this market come down. And I hope you're right in your thesis. But it's just, I love the conversation because there's so many variables, right? It's just like, and that's why I like talking to you, because I want to hear a different opinion of why And I'm not saying all stocks. You're seeing some great names down 50, 60%, good management teams, insider buys, and you cover this area well at Tocqueville. Yep. But for me, that's the thing. It's I just what companies I'm seeing a lot of companies where I think it's a good market for guys like you and me who analyze individual names, also sectors and ETFs and stuff. We'll talk about that in a minute. But the days of growth over the past 10, 11 years, you look at people with 10, 11, 12 years of experience, the only thing they've seen is they operate in a zero interest rate environment, right, for almost forever. When we're not going to have that, right? So it's where's the growth going to come from, especially without China, especially not the Fed, and that's what I'm worried about.
Well, let me answer a question one way. I think the S&P 500 in particular has tested its lows throughout the course of 2022, and I wouldn't be surprised if we retest those lows in the foreseeable future. That would not be surprising. I think the market. See, you had three in deconstructing the market sell-off this year. You had sort of three hurdles. The first hurdle was beginning of January, Fed saying we're going to have to raise rates, and higher interest rates means valuation multiples come down, right? So the first correction of the market was in technology, right? If you remember back in January and February. Early. Then you had Russia start the war with Ukraine. You had a geopolitical risk. That was the next leg down. And then you had in the spring, you had companies starting to adjust earnings more. So you had sort of those three legs, or adjust earnings downward for the first time, right? And analysts finally around May started to pull some earnings estimates in for the year. So you had sort of these three legs. Now, what have we seen over the past 2 months? You've seen valuation multiples increase because the market feels the Fed is near the end, right? The market can see that, okay, inflation has come over. The Fed has laid out a plan to get to 5% or so, but inflation has come down. We've seen peak inflation, so the Fed has done its job. So you've seen valuation multiples re-rate higher on the prospects that we've seen the peak of interest rates, okay? But what you have not seen come through yet is earnings estimates coming down lower. Earnings estimates are definitely going to – I'd be surprised if earnings estimates are not lower. The energy sector is the only place where investors have visibility on earnings, and energy is only 5.5% of the S&P 500.
But
to put that in context –
profits – 12% of the profits is
that's right.
That's what
that's right. So you have to look at things X energy for and you're going to see significantly more downgrades in terms of earnings estimates for sure. But you're going to get to the point where earnings estimates are going to trough, valuation multiples trough again. The Fed is done, and I think then that leads to a bullish case for stocks on the back half of 2023. It's just going to be very choppy getting to there. Where could I be wrong? Now the problem is again, and this is why we focus on being long-term investors and not traders, is, oh my God, John said, the stock market could go down, and what do you do in the short term? Do you rent the cash? What if I'm wrong? You know what I mean? What if the inflationary numbers come down faster than expected? What if Russia, there is some sort of resolution to Russia and Ukraine? There's a million things. What if the Republicans and Democrats during a lame duck session come out and resolve the debt ceiling during the lame duck session, and do concessions now? Rather than waiting for July when we have to deal with kicking the can down the road again for the debt ceiling, and we hope we don't have a repeat of 2011 where Congress held the debt ceiling, held the economy hostage, held the country hostage by waiting till the 11th hour on the debt ceiling. So I could come up with a million reasons, which is why you ultimately don't. I don't want to time this market, but expect the volatility that we've seen this year continue it easily for the next 5 to 6 months of next year for sure.
So where are you seeing the best value? Because we're seeing the S&P 500 still down 15% on the year. Where are you seeing the best value? Because I am seeing value, and value is it's so funny because value used to be such a bad word, right? It's a value trap, right? It's a value. You don't want value, you want growth. Where's the growth? Where's the growth? Obviously, we have problems going on with China. We have the Fed doing everything, raising rates. They're not going to be there like they were during the last two, really, like during COVID, lowering rates to zero. Buying bonds, same with the credit crisis, bailing out the banks, where they can't do that unless they want to create more inflation. So they're not there this time around, right? So, right. It's hard to see what areas will have growth. There are certain areas, but I think value comes into play here, like the IBM hitting a 52-week high, or Some of these names that have good balance sheets, good management teams that have been through this before, not just through COVID, but even past the credit crisis, and home builders that know how to cut and know exactly what to do during these times. Mm-hmm. Where are you seeing the most value here? And of course, you probably have to have a little bit of growth in there too.
Yeah, Frank, before I answer that question, I want to make a comment that's unique to probably a good portion of your listeners about where we are with the economy and the Fed. Because there are many listeners probably to your podcast that have never experienced a business cycle in their life. And what I mean by that is what's unique about today's environment is that we are in a classic business cycle slowdown. Now, Frank, go back to 2000, right? Think about 2000 to 2002. What caused the recession? Dot-com bubble burst, followed by 9/11, followed by Enron and WorldCom, right? That threw the economy into recession, and it threw the stock market into 3 years of terrible performance. Those are all exogenous shocks, right? We didn't know an asset bubble burst with the housing, with the dot-com, but we didn't know what was going to happen after 9/11, and we didn't know who else was cooking the books with Enron and WorldCom. Okay, fast forward to 2008. What happened? You had the housing market, which was an asset bubble, blow up, and you had a Lehman Brothers collapse, and you had the Federal Reserve having to inject capital into the banking system of something that hadn't been done since the Great Depression, right? That was Lehman Brothers collapsing and subprime mortgage market blowing up is an exogenous shock. Fast forward to 2020. What happened to what threw us into recession? We had a 100-year pandemic. Okay, again, an exogenous shock. So there are generations out there that have not seen a classic business cycle slowdown like we saw in the 60s and 70s. What caused the economy? What caused recessions in the 60s and 70s? The economy got overheated. The Federal Reserve had to raise interest rates. When you raise interest rates, it slows the economy. Companies' inventories build. They lay people off. They cut prices. And then eventually the economy resets. It finds a new market equilibrium. We expand. The Fed cuts interest rates, the economy expands, and we're off to the races again. It's a classic business cycle slowdown that many generations have not seen since the 60s and 70s, because every recession we've had since then has been some exogenous shock. And I can go back really to 1987, where you had the stock market blow up. I could go to 1994, where you had Mexico devalue the peso, 1997, a Thai baht devalue, 1998, long-term capital management blowing up. Those are all shocks to the system. This is the economy got overheated because too much money was pumped into the system. And now the Fed has taken the punch bowl away and is trying to slow an overheating economy to bring inflation down. I think it's very, very important that people understand, because we haven't seen a classic textbook business cycle slowdown in over 40 years. So I think that's unique, but textbook at the same time. But I guess to answer your question, about where I'm finding value, I still think there's value. I think when you look around, you landscape the world. Okay, I think large cap European multinationals are trading at a big discount to U.S. large cap multinationals. So, for example, right, if you have a healthcare company or an energy company that's domiciled in France or Switzerland or UK or something like that, they're priced in they're domiciled outside of the US, right? So the dollar is the strongest we've seen in 35 years. So automatically they get dinged because of the strength of the US dollar, right? Because you have the currency exchange. But they may get 20 or 30% of their sales in Europe. They may get 70% of their sales outside of Europe, right? So those companies are trading at a big discount for two reasons. One, because the dollar is so strong, and if they're European, because of Russia. They're close, the proximity of what's going on in Russia and inflation there. So I think there's tremendous value, although the energy sector has really rallied hard. European-based energy companies, the super majors. So basically, think of the Exxon and Chevrons, but of Europe. There's a great way to play it, I think. The iShares Global Energy ETF, IXC. You get a 3.5% dividend yield, and you own the mega cap U.S. based energy companies, but you also own the mega cap European companies. So you don't get caught; you get diversified through a basket of energy companies, and the European majors, super majors, are trading at massive discounts to the U.S. So, and all of those companies have found capital allocation religion like the U.S. Companies. The energy sector is making so much cash flow right now, and they finally realize that, hey, if we pay down our debt, if we grow our dividend, and we buy back our stock, and we don't pump more oil, and we keep the supply of oil tight, we're going to make a lot of money. And that credo is been spread throughout the entire energy space. So I think that is an interesting area. Not only so Europe, multinational European companies, large cap, that pay a big dividend, but they're global in their base. As a general statement, I think is attractive. I think specifically energy is really attractive, because I think the European energy names are trading at a big discount to the domestic. Now, listen, energy's been the best performing sector, and here I am pitching a sector that's been that's part of a group that's the best performing sector. But I think you have the cash flow and the visibility there, and given the structure within the energy market, the movement to LNG, the weakness of supply, the amount of strategic petroleum reserves the U.S. has blown through, which has to be replaced. I think that's an interesting place to be.
I love that thesis, because we're looking at, and I've done a lot of analysis on how technology companies are getting crushed from the high dollar, right? Especially technology companies.
Mm-hmm.
I mean, you're talking about even Nike, right? Nike said 20% of their operating profits are getting impacted. 20%. I mean, so I think it was something like $5 billion. And so it was like $1 billion, right? Their operating, whatever it was. I mean, it's an insane number just for the dollar. But yet, if you're looking at European companies that have exposure to the S, right, that's not a bad way to play it. But let me ask you this. When it comes to I've been told by so many people this thesis for at least the last 10 years that stocks, international stocks, are so cheap. Whether it was Russia, whether it was Europe, whether it was China, and the thesis has always been like, listen, you're better off buying U.S. companies with exposure in these places, because I mean, that thesis has just seemed to never work out over the past 10 years, buying international, where the U.S. continues to outperform. You'd have like periods that you can go back and you'll see. But for the most part, I mean, I can't tell you how many people told me to buy Russia before pre-war, and, didn't work out, and European and stuff like that. So, what's different this time? Is it the dollar? Because that seems like that could be very beneficial for those that are conglomerates and those that have, a lot of international business and all the foreign brands that we actually see here that we buy, right? You can look at stocks like that, but is it just Europe, or is it someplace else that you like as well internationally?
Yeah, so it's definitely it's Europe. It's developed. It's large cap. I like energy. I like European pharma companies as well. Again, stable franchises, good balance sheets, good cash flow. I'm not necessarily advocating for European consumer or something along those lines. And again, it's developed, not emerging market. I'm focusing more on Europe rather than China. Definitely the dollar is a play here. If the Fed does hint at reducing interest rates and eases at some point in time, the dollar will come off its high. And I think the valuation gap between domestic multinationals versus international multinationals is very, very wide. So if there's value to be had, I think that's a space to be. And energy in particular, I think owning a basket of these multinationals where you get some U.S. exposure, but you get the Europeans as well, I think is interesting. On the other side, Frank, kind of to barbell that, one of the things that we're doing for clients who had either excess cash, or we run some balanced portfolios where we're looking for income and fixed income, Frank, we're buying 90-day T-bills. We're getting. I know this isn't typically an equity focused, your newsletter and show and things like. We're buying 90-day, so 3-month and 6-month Treasury bills where we're getting over 4% yield. Wow. And you buy that in a tax sheltered account like an IRA. What's wrong with that? And when those mature come January, February, presumably by that time the Fed is going to have raised interest rates probably another 100 basis points, 1%. You figure if they do 50 basis, half of 1% in December, and let's say they do half of 1% in January, February, the yields on those will be higher. So we'll play that short term all day long. 2-year Treasury, you're getting 4.25%. For the first time, Frank, since 2004, 5, and 6, in the fixed income portion of your portfolio, you could actually get income. We're in the worst bond market in the history of the bond market. It's going to be the first time ever. We always talk about the S&P 500, but the Bloomberg Barclays aggregate, okay, for those not familiar with the fixed income market, the Bloomberg Barclays aggregate, the ticker is AGG, is the equivalent to the S&P 500 for bonds. When you say the bond market, you typically refer to the AGG. The AGG is going to be negative for 2 consecutive years. That has never happened before, ever. So, an environment where you have the stock market volatility is through the roof, investors who had some fixed income can't find any protection. But now, you ask yourself the question, if I didn't own it before, would I buy it today? Today, bonds are attractive. And you don't have to go very far, and you don't have to own long dated bonds, and you don't have to buy the crappiest credit to get yield. You could buy US Treasuries for 90 days and get 4% on your return. And we're doing that for clients because we have visibility, and we'll take it.
And it's a key. One thing we both agree on this, even if we have like different opinions of how it would work out, is the volatility that we're going to see over the next 6 months, right? So it's going to be crazy. And that,
it's going to be high.
Throw yourself in a 2-year at, I think it's actually 4.3, 4.4 risk-free compared to dealing with, again, we're talking about, this week alone where China was rising protests, crazy. I mean, that's a death sentence when you protest against the government. That's how frustrated they are with COVID policies. And the very next day, the government comes out, which very hard to believe what they say, but, we're probably going to pull back on it. And 1 day later, it's okay. And same with the Fed. Like, everybody's nervous. Now the Fed, it's just going through this volatility. We're just talking about this week, right?
But Frank, let me ask you a question. Let me ask you a question, right? A 2-year U.S. Treasury right now, as you say, is around 4.5%.
Yep.
Okay. Mm-hmm. Over the next 2 years from today, do you think stocks will outperform 4.5% annually?
Wow, that's a good question.
I'd say yes. I think stocks, looking back 2 years from now, on a compounded annual basis, stocks will outperform 4.5%. But that doesn't mean you avoid the 2-year, right? But if I can go out 6 months now let me ask you another question. 6 months from now, if I could buy a U.S. Treasury bill and get 4.25% is about what a 6-month T-bill is offering, 4.25%, something like that. Do you think stocks are going to outperform 4.25% in the next 6 months? You're going to say, I have no idea. Maybe. We had a day 2 weeks or 3 weeks ago where the stock was up 5% one day. But 6 months from now, you're like, I don't know, right? But you could lock up 4.25% return for 6 months. 2 years from now, I'm going to bet that stocks will outperform bonds over the next 2 years, right? So, but that's the environment that we're in. That we're in this period of uncertainty, and you could play out a million different scenarios and assign a million different probabilities. And you know what? They all could be right. Each one has credence to it, So anyway, I gave two really different scenarios here, right? So, but I think the crux behind all of it is that I have visibility. I think, that despite the asset has done well, I think there's continued visibility in the cash flow of the energy sector. And I think there's visibility in high quality 90-day, 6-month, 1-year Treasury bills where I can get 4% yield.
And it is an interesting question because if we look for the average investor who aren't like us, who breed the markets, look at every stock, look at every sector and everything, right? So we have great conversations about this, but I don't know where the market's going to be. I would tell you that Meta, I think, would be 6% higher. I think it's, whatever. Yes, it was 4-5% higher already, whatever. But because it's down 60-65%, right? I don't know if it's going to go lower than that over there. But when I'm looking at individual names and I'm seeing, so a good example that you brought up was the oil sector, where I don't know if I'm too crazy bullish on all of oil that have made, massive moves, right? We're seeing fracking, we're seeing companies, US-based companies, even Exxons and stuff like that make nice moves. But which hasn't followed as much is the oil services. And you mentioned international, and now, being screwed by Russia. I mean, they're all talking about this massive growth spurt in huge drilling, all international, that these guys it was just negative on that balance sheet for such a long time, just getting crushed, losing money on this, where this is a big boom to that specific sector, right? So when I'm looking at individual names, I could say, yes, I know that I could generate, or I have confidence in what I know that I could generate those returns, but I'm not, we talk about the market in general, where the whole market's going to be. I'm not too sure. I do know there's a lot of stocks that are incredibly overvalued, but when you're really looking under the hood now, which you have to do, you just can't buy any growth stock and like Disney and adding subscribers, and nobody cares how much they're adding them for. Right now they care, right? Numbers matter, especially when rates higher, debt's higher. You're paying for this stuff. Yeah, I think it's going to matter what individual stocks you actually have in your portfolio. So we talk about the markets in general. I don't know, but I know there's a lot of stocks, even though I'm seeing that are down 60%, that still probably have a ways to go because their growth profiles are still trading crazy valuations.
Yeah, I think when you talk about the energy services company, I'm sort of torn because I see how short in terms of global supply is right now, and what needs to be repaired because the global E&P majors basically shut off their capex over the last 2 years because the price of oil went negative. You're not going to be incentivized, when oil goes that low, right? So my problem with the oil services guys is that they basically eat off the scraps from Exxon and those guys' table, right? When those guys want to spend money, then the oil service guys do well. When they don't, then they don't do well, right? So from a fundamental business standpoint, I wrestle with that because they're so reliant on the E&P guys basically doling out the cash to them to spend. But at the same time, you could have a massive capex cycle prolonged for a long time just because energy stocks have been depleted so much. So but again, I think to your point is exactly right. You have to. We're back to good old fashioned stock picking rather than
who has most international exposure, who has the exposure to the conglomerates. I mean, this is things that we do, right? Which are fun when people are probably like, all right, enough of this. Just give us the name.
Yeah, that's right. That's right.
Yeah,
cool. That's right. So, that's right.
Yeah, that's right. You shared names. So you said some of your favorite ideas. Also, talk about ETFs, which you're offering at Tocqueville and things like that. Because I know people want to learn more about you as well, but I know that you guys have a pretty big ETF following as
well. So we build separate accounts for clients, which means that we pick individual stocks and bonds, but we also use ETFs and mutual funds. So our bread and butter really is picking individual stocks and bonds. I chose to pitch an ETF here today just for compliance reasons. It's easier than individual stocks. But I think directionally, my team within clients, especially for those clients that are looking for cash flow needs, those are some of the ideas that we're looking at. Short duration, high quality fixed income, and then on the other side of it, dividend producing equities. And in this case, energy, where I still think there's some visibility. I've been on the show in the past. I pitched energy and some of the master limited partnerships, the oil and gas pipelines. But this is more within the E&Ps. So so I appreciate that.
And if someone wants to get in touch with you, they can just go to your website or learn more. I mean, plus you're on TV.
Yeah, go to our
TV all the time. Yeah.
Yeah. So go on our website, under you'll find my name and all my contact information, more information about my team specifically at Tocqueville. We're an independent registered investment advisor with the SEC, and we manage for tax efficiency. We build out individual portfolios for clients needing income or growth or capital appreciation, and and then I get to do fun things and talk with you. So it's all good.
Just remember the small guys like me, because now I see you on TV all the time, and it's great to see that success, man. You definitely deserve it. You can tell you put in the work. I love having conversations with you, and we always text each other. Been friends for a long time, but I always really
same here, Frank.
So.
Yeah, absolutely.
I can't let you go. I know you probably need to go, but I can't let you go without talking about the last thing here, which is probably most important for many people, is your fantasy football team, because we always get an update. So I'm this year because I'm so busy. I am in first place with a partner. I'm doing very, very well, but how's your fantasy doing this year with your son?
So I'm in 3 leagues. 3 leagues. One of them mathematically eliminated. The second league, it's a long shot to make the playoffs. And in the other league with my son, we're in second place. So so for 3 leagues, that's what you probably have diversified. I have a shot on one of them and terrible on the other. So I don't know. I made some bets, Frank. I waited on Derek Carr in later rounds, hoping that with the receiver, I forget his name, and Josh Daniels, that would work. And Carr has not been lived up. And I drafted Kyle Pitts early, the tight end from Atlanta, thinking that he was potentially going to be the next Jimmy Graham, and now the guy's on IR. So that's been this.
It's so
Totally.
it is. Jonathan Taylor, number one pick.
So
Look at that. I mean, it's Barkley comes back and is doing great, which is, you have to worry about that picking him early because of injuries. But I just love it because it does bring people together and it's a lot of fun. And you always talking and you talk to your friends and you and your son and stuff like that. So
Frank, we have to have another conversation this year. You know what I've gotten the last couple of years? You know what I've gotten into? I'm in a survivor pool for Formula One.
Really? That's interesting.
I have no idea. It's awesome, actually. I've done it. It's awesome. And I've had no interest in Formula One until this. And it is so much fun and it's super easy to do. We should talk offline about it. And then there's another one that I've in. My son has gotten into soccer and we're in a Premier League fantasy soccer league, which
that's pretty cool.
I have no idea about, but it's actually pretty interesting. And soccer is significant. I've learned my exposure to soccer is the World Cup. And, half the games I fall asleep through because they're, 1-0 or 2-1 or something. And everyone plays defensive because they don't want to lose, right? The Premier League is not that. I mean, these games are 3-1, 10 minutes in, and the athleticism. I don't know. It's been pretty eye-opening for someone who has cared only about football, baseball, hockey, and basketball my entire life. So
it is incredible, even with the World Cup going on right now. So, listen, thank you so much for everything. I really appreciate you coming on as always. You always get great advice and ideas, and hopefully join us again soon, buddy.
Yeah, thanks, Frank. Thanks for having me on.
All right, cool. All right, guys. So great stuff from John. Said very, very good friend, even better person. I've known him for a while. But I always say this podcast is about you, not about me. So let me know what you thought of the interview. Anything, any questions, frankcurzioresearch.com. That's frank@curzioresearch.com. Thank you so much for listening. I say this all the time and I mean it. Really appreciate all the support. I'll see you guys next week. Take care.